The Fed just dropped a silent bomb. Higher inflation and higher unemployment could hit in 2025, and no one's ready for it.
Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
The Federal Reserve isn't cutting rates. They're holding steady at 4.25% to 4.5%. But behind the scenes, they're warning. Stagflation might be on the horizon. That's the toxic combo of rising prices and a slowing economy. Yep, the worst of both worlds. Why? Trump's new 145% tariffs on China. The Fed didn't name him directly, but they made it clear trade chaos is screwing with the data. Even Fed Chair Jerome Powell admits we don't have to be in a hurry. Translation? Brace yourself. This pain might last. Prices are still high. Interest rates on credit cards, over 21%. Mortgages, still elevated. And job growth, slowing, but not collapsing. Yet. The Fed's stuck between two bad choices. Cut rates too soon, risk inflation. Wait too long, risk a recession. Wall Street's holding steady, for now. But retail investors, you, me, regular Americans, we're still buying. 21 weeks straight, a record. Because guess what? We still need to retire, pay off debt, survive. Here's what you need to watch. Signs of job losses, inflation spikes, tariff escalations. Because if all three hit, the Fed won't save us, not in time.
In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now, and we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
This isn't fear-mongering, it's a warning. And the people who prepare now, they'll be the ones who survive 2025 with their money intact. Stay smart, stay ready, share and subscribe for the real story that actually affect your wallet.